So I was telling Amy, I'm like, with everything that's been going on over the last couple of weeks, I borrowed this presentation from an online learning class that I found. But we're going to talk about federal government-backed loans this morning. So for most of you, you've been in the business long enough that you know a government-backed loan is like FHA, VA loans, CalVet, USDA, lots of options out there for our borrowers, which is fantastic. So FHA are not, they are insured by the government. So the loan is made from a typical lender. So for us, UWM is one of our big ones. And they actually just sent out an email this morning with some really good news. They have lowered their minimum credit score for VA and FHA loans to 580. In the past, FHA has predominantly been 580, sorry. But VA, even though the VA does not have a requirement for a credit score, almost every lender out there does, and it's normally about 620. So having 580 for VA helps our veterans a lot. Oops, sorry, didn't mean to do that. Okay, so FHA requires upfront mortgage insurance premium, which many of you probably know was lowered from 0.85 to 0.55 this year, which is fantastic news for our borrowers. It has been, mortgage insurance is necessary, and yet it causes additional costs for our borrowers, so it does take down their purchasing price. So obviously payments, principal insurance taxes, yeah. And sorry, I got distracted by my dogs. Yeah, I'm like, they're over here playing with their toys. So principal and interest taxes and insurance. My brain will work this morning, I swear. No maximum price, but there are maximum loan amounts. As you guys know, there are conforming loan limits, and they change based on where you are located in the country and what county you're in. So around here, we have a lot of different conforming loan limits. For Vacaville, it's 726,600. And that is for units from 1 to 4 residential units. So you can actually buy a fourplex, and it still falls under like regular single family residence guidelines. And then discount points are negotiable and paid by either party. There are limits on them though. So always check with your lender before you start talking credits with your seller or even your buyers, because you want to make sure that you're not going to go out of those limits when you're writing your offers or doing addendums. So advantages of FHA, obviously, one of the best things about it is that the minimum down payment that you have to come up with is 3.5%, which is pretty great. And normally a lot more doable for people than 20%. There's no prepayment penalty. There are minimum property standards. So I know you guys probably run into this when you're writing offers occasionally for FHA loans. Sorry. Where the sometimes you'll go into the MLS and the MLS will say conventional or cash only offers because of the condition that the property is in, because all government backed loans do have minimum requirements that you have to make. So one of the things that it says here is that one of the disadvantages of FHA is increased processing time. For us, for the most part, that's not true, not for your typical FHA product. If you were talking about CalHAFA, FHA products, CalHAFA products in general tend to take a little bit longer. They are actually normally pretty on top of it. And as long as we can get our files submitted right up at the beginning, we haven't had a lot of delay with that either. Again, property requirements may discourage the sellers. We don't see that as much with FHA as we do with VA. And the cost of mortgage insurance, again, decreases the amount of the home loan for how much that they can afford. All right. Nope, I went too far again. All right, next up is the FHA 203B. How many of you guys have heard about this loan?
Never heard of it.
So, an FHA 203B, and there's also like 203K. There is renovation loans that you can get with FHA. Just know that if you ever choose to do one of these with your clients, they do take longer. There's more hoops that you have to jump through. But you get to do, 3.5% down still. But as you can see, your maximum loan is 95% of the medium home or 75%, whichever is less of FNMA. I do not know what our current maximum is in our area. Sorry, I borrowed this morning, so I have not ran numbers on this. Okay, VA loans. This one is probably one of my favorites. And also, shockingly, for the area that we live in, one of the most misunderstood loans, I feel like. So the VA guarantees the loan to protect the lender. It says interest rates are negotiable between borrower and lender. Interest rates are technically always negotiable if you do buy downs. But as far as like actually having a negotiation conversation, we don't select our pricing. The lenders that we work with do. So we have to go with whatever rates they have at the time. You can also assume a VA loan. The downsides to this for the person that's selling the home is if they transfer their VA loan to your borrower, they've lost their VA eligibility because most of them don't have enough eligibility to do 2 houses. So just heads up for you guys, if you ever have a borrower that's kind of looking for that, just know it can be very difficult to get a seller to want to transfer that loan because of that little stipulation that comes with it. Amy, go ahead.
Now, I was talking with somebody, and if the buyer of the home that's assuming the VA loan is also VA and has eligibility, they can assign their VA eligibility to the sellers so that they can resume their purchase wherever they're getting PCS to, for the most part.
So I don't know, because I actually just heard that too, and I've not had a chance to check on it. So I will do that. I think you're probably right with the assumable loans. I don't know why they don't just make it where if you have VA eligibility, you can just transfer that onto the loan. But I'm like, they enjoy giving us lots of extra little steps. I'll share this with you guys because I'm going through it right now. Most of you know, Sammy's dad passed away, and he has a house in Oklahoma that has a VA loan on it. Now, I am not on that loan. And so now what I get to find out, and I have no answers on this, even as a lender, I've never dealt with this situation before, whether I can assume that loan or not, or if we have to refinance out of it, or what we have to do upon the passing of an active duty member. So that is my new learning thing that I will tell you guys all about once I have been through the entire thing. Because I think it is a very good thing to know when you're talking to your borrowers. VA does require that credit be pulled for both spouses. You are not required to be on the loan though. All right, so let's see. Value determined by certificate of reasonable value. We also pull a certificate of eligibility or their DD 214. So when we pre-qualify your borrowers with a VA loan, we actually pull that certificate of eligibility at the application process. We do not wait until you are in contract because we need to know if we're going to run into any hiccups with that. So we always pull it right away. Your VA borrower is not required to put anything down on the property. They do have to pay closing costs though. A lot of VA buyers are under the assumption that they can get into a house with absolutely no money out of pocket. But that is not the case. Obviously there's still closing costs, but they are not required to put down a down payment. And then of course the veteran must occupy the property. All right, go ahead.
Yeah. Are there any assumable loans for non-VA loans, or is it only for VA?
I had started looking into that prior to leaving. I have not finished research on it because I feel like there is the option to assume other loans. But I don't know off the top of my head which ones they are. So I will get you that information. But it'll be a little bit, but I promise I'll have it before we have our next class. So
Thank you.
you're welcome. Interest rates on VA loans are normally lower. VA and FHA are normally right now, they've been sitting a good probably 3/4 to a full point lower than conventional loan rates have been, which is always a good thing. No prepayment penalty to pay off that loan. So you get a 30-year loan, you pay it off in 10 years. There's no prepayment penalty for that. It used to be that certain loans, if you pay them off early, the bank hit you with a penalty fee for paying that loan off early, which is crazy. And I'm glad they got rid of it. Can be used more than once if the old VA loan is paid off and the veteran is released from it. We have ran into issues where the veteran has sold the home in the past, but for some reason their eligibility has not been given back to them. And that is actually a very simple fix. Our processor, Hallie, just did it for one of our clients. It doesn't take that long and it's not that complicated, as long as they actually do still have that eligibility. Also, if they are a disabled veteran, they can actually get out of paying the funding fee that comes with the VA loans. Okay, so only a veteran qualifies. I would rephrase that to say veterans or widows, because if your husband passes away, you as a spouse retain that VA eligibility. The other big thing is that you can't, on a normal loan, you can have multiple parties that are going to go on the mortgage. So like if me, Amy, and Anastasia all wanted to go in and buy a house together, we can. If we're doing a VA loan, unless Amy and Anastasia also have VA eligibility, we cannot go on that loan together. So you either have to be married or everybody that's going on the loan has to have VA eligibility to qualify. And the reason I'm telling you this is it's actually a really great purchasing option for your younger military guys that are out here. If they have friends that they trust, going in and buying a house together versus living in the dorms on base or paying rental prices right now, may be a good move for them. So if you're looking for a little extra marketing ideas, that one's a great one, especially for the base out here. So loans are assumable, but not without a credit check and an assumption fee. Red tape with government may take longer for approval. Again, we don't really run into that these days. I know that that other companies do run into it. So if you have ever worked with USAA, most of you will know that they tend to take a little bit longer. And by a little bit, I mean like 45 days to get through. So, and they tell you that they can't do it faster than that. They can, they just don't. So if you have clients who are pre-qualified with USAA, if you can get them to talk to another lender, whether it's us or somebody that you already work with and know and trust, try and get them to talk to a local lender, especially in this market. If they're, not putting anything down, being able to close faster is a really great negotiating tool for your client. All right. So, loans to owner occupied qualified veterans for their homes, no money down on a maximum home loan amount equal to the Fannie Mae loan limit, which again for Vacaville 726,600. Interest is determined in current marketplaces. So if you guys look at interest rates in California versus interest rates where Amy's at, there is a difference because my sister and I talk about this all the time. She sells real estate in North Dakota. And they are almost consistently a point or more lower than we are on our interest rates, which should tell you a lot about California. It's crazy.
I actually, because I just inquired on, I don't even know what today is, Monday.
Mhm.
about investment properties, and it's like, oh, what are the current rates right now? And he was like, oh, we're at like 6.5%, 7%. I was like, on an investment property? Cool.
Yeah, which is really great because I can tell you in California, you're not going to see that.
No.
So that's what I'm talking about. Different areas. So if you choose to get licensed in Nevada, Rena's not that far away. So, I mean, it's not the worst idea ever. Just don't do it unless you actually really know the area or get to know it, because other money building activities is never a bad thing, but get to know the interest rates in that area too. Okay. The vet is charged funding fees. That funding fee changes based on whether it is their first use or second use or anything past the second use. It also changes depending on how much they're putting down. So it's like 0 to 5% is one rate, and then like anything over 5 to 10, and then 20. And give me 1 second and I'll tell you guys what those are. If you need to find it, you can go either you can Google it online if you want a really easy way to do it. You can go to my Instagram page or the Brick House Instagram page. I have the new funding fees on there because they actually just changed as of April 7th this year. So for first use, if they're doing less than 5% down, the funding fee is 2.15%. 5% or more is 1.5. Sorry. 10% or more is 1.25, and that's for your first use. If you're looking at subsequent use, again, these are based on how much they're putting down. So less than 5%, that funding fee is going to jump up to 3.3%. And then 5% or more is 1.5, 10% or more is 1.25. So if they can, it really is in their best interest to put more than 5% down because it cuts that funding fee pretty dramatically for them, which is always good and saves them money. And again, if they have, if they're receiving disability, then depending on what that disability rating is, we can either get a discount or completely waive that funding fee. All right, CalVet is something we don't use a lot. We normally just do your regular VA loans, but CalVet is for California Farm and Home Purchase Program. So all vets residing in California, the title is in the name of the state of California, and then the title will pass to the vet when the state is paid off. So when that loan's completely paid off. The vet can get long-term lease and land contracts. And then we as the loan brokers can process the loan. It is variable rate, and the funds are received from the sale of bonds. So it's definitely a little bit different. And in last time I looked at it, for the most part, CalVet loans are not as advantageous to use as like a regular VA loan is. So I'm going to skip this one. Oh, I will point out this. Regular CalVet loans do require a 2 to 3% down payment versus VA, which does not require anything. So if you have a client that's looking at that, they really should look at just using their regular VA loan. So this kind of just shows you what the flow of funds looks like when your borrower is getting a loan or like when you get a loan. So they get the note. So there's primary lenders and there's secondary lenders, or the secondary market, I should say. So when I worked with Sonia and we were at Homeowners, we didn't keep those loans. Homeowners was not the one that was servicing those loans. So we would process the loan in-house, have underwriting, and then that loan would be sold to the secondary market, where it would end up with like Chase, Wells Fargo, or another company. And so your borrower or you would get a notice saying, hey, your loan's been sold. We're going to send you the new information. You'll have it within like 15 days. That's what the secondary market is. And so now with working on the broker side, the difference is that we have an in-house processor, but our underwriters actually belong to the bank that we're working with. So if we're working with UWM, we're using their underwriters, following their overlays. And then depending on which bank it is, they do either keep the loan or they sell it to the secondary market. And it just kind of depends on who we're working with or what kind of loan it is. And for those of you that don't know what the secondary mortgage market is, it is created by the Federal National Mortgage Association and Fannie Mae, issues stocks to the general public, provides blended mortgage rates, issues mortgage-backed securities. If you guys have been going to the finance forums, then you have heard the term mortgage-backed securities a lot. If you watch any of the conversations that come out that affect our rates, those are the ones that everybody likes to pay the most attention to. And the secondary mortgage market is a lot of FHA, VA, conventional 1 to 4 units. Again, depends on who that lender is that you're working with. And then there's the Federal Home Loan Mortgage Corporation with Freddie Mac, which again issues stocks to the general public, buys and resells residential conventional mortgage loans, and requires loan assurance that the loan is over 80% of the appraised value. So, and then there's also Ginnie Mae, the Government National Mortgage Association, which guarantees securities issued by FHA approved home mortgage lenders. I know it's a lot of very boring terms that most of you will not remember, other than probably Fannie Mae, Freddie Mac, and Ginnie Mae. So that is my slide for you guys today. I'm trying to think if there's anything that I forgot to tell you about government-backed loans. I think we covered it all. What questions do you guys have? I know I just, again, threw a lot of information at you in a short period of time. And I apologize again, because this is not my most prepared with how the last couple of weeks have been, but I am here to answer any questions that you guys have, if you can think of any.
What are USDA loans like, and what are some of the, what are the requirements for USDA loans? I heard that like certain places have them,
yes,
but not other cities. And so how do those work?
Okay, so Dixon is one of the cities that falls under the USDA loan territory. So let me go here. All right, let me share my screen with you guys again. Hold on 2 seconds. I'm going to show you what I'm looking at. Okay, so if you come to Google and you Google USDA loans, this is what you're going to want to do to check your address. You can literally just come here to United States Department of Agriculture, and it's going to walk you through everything, including the map. So this will walk you through eligibility. So for the most part, you're going to do single family. So it'll talk to you about this here. Income eligibility. So if you come here, click California, and then come and pick our county. This is what it's going to ask you. Number of people in household, we'll just say 4. Number of residents under 18. Is the loan applicant 62 or older? Any disabled people? No. You're gonna go next. And this is
when they refer to disabled, are they like military disabled, physically disabled, not somebody that retired from a job because they're disabled?
Correct. So right here, it tells you everything that they take. So it says reasonable expenses for the care of an individual with disabilities in excess of 3% of the annual income. When combined with eligible medical expenses may be deducted from the annual income if the expenses enable the individual with disabilities or another family member to work, are not reimbursable from insurance or any other source, do not exceed the amount of earned income in the annual income by the person who is able to work as a result of the expenses. And then it'll actually walk you through those expenses down here. So like a care attendant to assist an individual with disabilities with daily activities, of daily living directly related to permitting the individual or another family member to work. Special apparatus such as wheelchairs, ramps, adaptations to vehicles or workplace equipment, if directly related to permitting the individual with disabilities or another family member to work. So they do have very specific things. And they let you walk through this and put everything in. So if they have 2 kids, let's say they're in school, they may not be paying, but we'll do like 15, annual one. We'll do like 18,000 a year. See. Okay. I'm just throwing numbers in there. So applicant does not meet the income limits. So, and then they show you here. Summary of adjusted annual household income. It tells you total deductions. And then it tells you what the max that they can make is. So maximum adjusted household income for selected state and county is $86,900. Maximum adjusted household income for our county is 125, basically 124,900, and you cannot exceed those limits. It's like CalHFA. And they do have this, so you can actually come in here and take a look. It's not the prettiest though, so it may be faster for you to use the website versus like trying to click through here, especially because the map is not clickable. USDA is a great option if your borrower can qualify for it, because USDA is 0 down, just like VA. And so if you can find a property and your borrower can qualify for it, it's a great option for them to look at. Yeah, Amy, go ahead.
Also on the USDA, the mortgage insurance, is it still less than going FHA? Because I know it used to be.
Yeah, I believe so. I don't think it's higher than it. Yeah, I haven't seen any changes that would make it higher, even with the lowering. And then the other thing that you should take a look at, and these are a little bit harder to track because sometimes they're just through the housing development that's happening. So for those of you that went on the tour to see the properties in Winters at the new development out there, they have income restricted properties, which I think is actually a great option in California right now with where housing prices and interest rates are. The biggest thing though is that they are income restricted, which means that you cannot make above a certain amount. And the other thing is, particularly with the houses in Winters that we went to go see, is that they're deed restricted for 10 years. And what that means is you have to live in that property for 10 years. You cannot rent it out to another family. And when you go to sell it, you have to sell it through the program in the city for the next 10 years, which means that your income potential is limited versus buying a property that doesn't have those income restrictions.
But you're also getting a house that would price less than, because it's income restricted, you're getting house price less than what it would have been on the open market as well. So.
Yeah. The one thing that got me about it is that with what the house costs and what the income restrictions are, if your borrower has a decent amount of debt, they can't qualify for the loan to purchase the property because, again, their income is restricted. You can't make over X amount of dollars. And apologies because I don't remember what the number is off the top of my head. I know it's a little, I want to say it's like 80 something. And so depending on what other debt that you have, it can knock you out of qualifying for that loan very, very easily. So it's one of those, if you can do it, it is fantastic. I actually looked at potentially buying one of those, but we made too much money. Anastasia?
Is this might be a stupid question. Is BMR and the income restricted, is that the same thing? Below market rate?
Yes. And
Okay.
then for one person, it's like right under 90,000. This year it changed. It actually went down $2,000 from last year's limits. So it's like 89,200, I believe.
Yeah,
Or
I think you're
it's
right.
88,200 is for one person. For two people, it's 100,800. For three people, it's 113,400. For a family of four, it's 125,880. A family of five is 135,960, and then it goes up like $10,000 for each additional family member.
Yeah. So it is one of those things that it could be tricky to qualify. It's probably better for a single person purchasing or a family of two. Because once you start getting up there, most people, when you have that many kids, are making more money than that. So, Woodland has a lot of the developers around here do. I have not seen it in Vacaville. Has anybody seen it at any of the Vacaville developers? No.
I don't think Vacaville has it. I think Fairfield has BMRs as well.
Oh, nice. Okay. I didn't know that Fairfield had brought it. It used to be that it was like, Vacaville and Fairfield like never had them, but you could go to Woodland or Winters or, the other surrounding cities and they have them, which always just confused me. But they are another good option for your borrower if they can qualify.
And don't a lot of them require that you go through a class?
So
for that as well?
CalHAFA requires it. I don't remember the lady at the Winters development saying that you have to take a class for it. I don't think you do. I think it's only CalHAFA.
Okay.
I think you
Okay.
do. My clients purchased last year and they did have to go through.
They had to go through a class. Okay, give me
Yeah.
2 seconds because
Because you get a certificate for it when you're done.
okay. Let me see.
And also update on those homes in Winters, because I was talking to them yesterday and a few days ago, and they don't have any more BMRs available. There was one person who was going to go in and deposit her check, and I don't know if she went in because that's the same day that I went in, but I think they're all in contract right now.
Oh, okay. I'm not surprised because that was they really were like great properties. I'm trying to see.
And Winners is pretty good with that anytime they have a new development go in, some of those homes end up being, it has to do with their city plan and some of the grants and stuff the city has gotten, that they require a certain percentage of the housing to be that low to moderate income housing. So they've got, usually with every new development, they've got a few houses that come available.
Yeah, which is great. Yeah, on this email from Sherry, I'm glad you know that, Maziel, because she does not have that on here for the requirements for doing that. So thank you for sharing that information.
You're welcome.
Like, see, teamwork. It makes the dream work.
And Maciel, on the resale restrictions on that, you can sell it. You have to go through the program and then it's got an equity share component, correct?
Yeah. So, yeah. And then, so if you sell it back before the 10 years, because they give you like a $10,000 loan. So should you sell it back before the 10 years, you have to pay that back at a certain percentage, like each year, whatever year you're selling it back. So if it's like 3 years in, then you would do a prorated amount. And I believe it's at 3% interest is what they charge you per year.
Perfect. Yeah. And that's one of those, if you find those, make sure you get all of those details. Because on our end, we're not going to get all those when we're working with you guys. So it's stuff that you'll want to find out for your clients, sorry. So, okay, I can't think of anything else. Do you guys have any other questions? No. Thank you
I
all
do.
for being, oh, go ahead.
I do. One more. I know the rates are changing, like, they change every day, every few hours, but can you tell us what they're at? Like right now and when they're next, I guess, like if there's like a next like big meeting that they're having that might sway the rates to go up or down or stay the same.
Yeah, I have not looked at what the next meeting is, but I'll actually show you guys what this looks like real quick. When we come in here and just one of our pricing engines. Let me just get it up real quick. And I'll kind of show you what we look at when we're coming in here and doing pricing and how we can kind of play with it.
And before I forget, for the next question that I have after we pull up the rates is, what is the maximum buy down option that you can do for, and I don't know if it's for each different loan, if there's a different type of loan that you can do like a max buy down.
So
what is
yeah,
that? What is that?
I'll
like?
actually, I'll show you in here with this. I'll show you what we look at. And then this is how we get to determine what we can and cannot do. Okay, can you guys see my screen okay?
Yes.
Okay, so this is our UWM pricing engine. So this is where we come in, we put in our client's information, and then we pull it. So I'm just going to put test. And this is where, let's say that we just happen to have a borrower that can do all 3 loans. Okay, because I'm going to show you what this looks like. So 375. This one was a one we already have in here. So that's what I'm going to show you. And this is let's actually just do, I want to do a lower amount, sorry. Because this scenario, we had a lot of cash coming in. So we're going to do 10% down. Oh, wrong, sorry. And then California, Vacaville, 751 credit score. We put in their monthly income. We come through here, mortgage insurance type. We're going to do monthly. Number of borrowers. This will let us click whether it's new construction or if they're self-employed. And then we're going to do lender pay compensation, which doesn't really, if we are working with a client who has, we need to be a little bit more competitive with, we'll do borrower paid and then play with it that way. Which I know they sound kind of weird, but it allows us to play with the pricing a little bit more than if we go lender paid. So this is not a first time home buyer. So even for FHA, or not FHA, sorry, for VA, we're going to do subsequent use, assuming that they've already used it, financing, the insurance, and then we literally just click get quote. And this will let you guys look at the pricing for everything today, kind of where it roughly is. And again, this is going to depend on purchase price, how much they're putting down, what their credit score is. Credit score is really a big one. So VA at a 751 is sitting around 7.1 right now. This is FHA at 7.03. So you can see rates are up after this weekend. And conventional sitting at about 7.625. So when you're talking about buy downs, what we do is we click see more rates and we come in here and it will show you exactly how far down we can go. So technically we could go all the way down to a 4.875, but this number right here, this $51,947 is what it's going to cost them to get down to that rate. And so this number is going to change based on what the daily rate is, if that makes sense. Does that kind of answer your question?
Yes, thank you.
Okay. So it does. It gets very expensive very fast. But sometimes If your borrower is buying a house, if they're coming in with a good amount of cash and they know that this is a house that they're going to be in for a good amount of years, like let's say they're buying it, they plan on having their kids in there, raising their kids there all the way through high school, and staying in that house for 20 years. And they have a good amount of cash. Instead of putting that money towards like a down payment on the property, they might want to throw $50K at buying down the rate.
So okay. So I have been told by like another lender that they can only do like the maximum buy down is 3 points, which 3 points is like 0.75, correct? Because each point is 0.25.
So if you look, right, there is a certain amount that you can do for buy downs, but it will give us the pricing all the way down to here. And so these are the number of points. So this would take it to 5. But it's going to depend on their situation. I've never had anybody even remotely go this far. For the most part, when we have people doing buy downs, you're looking at like a point. Most people don't go over that, but it will give us pricing all the way down to here.
So but people can do it. It's not like it's not like you cannot do it, because
it's going to depend on what other credits they have, and what we're working with numbers wise, because you're right, there are limitations on it. I've never had anybody go this low.
And I guess, and then another thing also is like, what would be like an advantage, or I guess a disadvantage of somebody doing like the 2-1 buy downs or the 3-2-1 buy downs? Like, what is the advantage for somebody? Like right now the rates are higher, so like you would think that would be helpful, but I guess what would be the disadvantage then if they do one now and then come out even better than what a 30-year would be after the third year of the buy down?
There's really not a disadvantage to doing a 2-1 buy down or a 3-2-1 buy down, because the money that you're going to put into that buy down for the next couple of years, let's say you refinance in a year, any money that's left in the escrow account that was for that buy down actually goes back to you as the borrower and goes towards, can go towards the principal or like closing costs for refinancing your loan. So that money comes back to you. So there's no disadvantage in my opinion.
So like, why would banks offer something like that where a lot of people can do that versus like a 15 or 30 year? And then is it just like to get them into their like portfolio, or like what?
Yeah,
you know what I mean?
The thing is that if the rates go down, right, most likely you're going to refinance with the same bank that you purchased with. So a 3-2-1 buy down is allowing you to take your interest rate down, and the bank is hoping that when you go to refinance that loan, or we come out of this period, whether it's 2 years or 3 years, that you're going to keep your loan with them.
Got it. Okay.
Yeah. So it's their job to make sure that as your mortgage partner, that they're giving you good service, right? Like if you call them and have questions, most people don't talk to their mortgage companies ever unless they need something. So again, most people are, when you go to refinance, your brain kind of just automatically goes to, I'm going to refinance with the company that I'm currently with. Depending on your personality, because type A personalities will probably still shop that rate with other companies. And then that company might lose the loan if they don't have the lowest rates. But for you, the borrower, there's really not a downside in my opinion to it. I think it's a great option, especially with what the market's doing right now. Hopefully now that the 4th of July is done, we will see some shifting in the rates. But for those of you who came to the NSCAR talk where they had the chief economist from CAR, he predicted that this is what the rates were going to do. He said that they were going to go up and that we might even see 8s before the market starts to go back down. So it will be very interesting to see what happens over the next couple of months.
Holy moly, back to 8. Oh my gosh. Okay. So how does it work with the buy down when you're buying down a regular like rate versus the 2-1 buy down? Like, how does that work?
So if it's really just cost and how they do it, how they structure it. Because the thing is if you're doing a permanent rate buy down, we can qualify you with that rate that you're buying it down to. With a 3-2-1 buy down or a 2-1 buy down, I have to qualify you at what the rate is today. So it doesn't matter if today it's a 7, but for your first year, you're going to have a 4 and then a 5 and then a 6 before you go up to 7. I have to qualify you at the 7% interest rate because that's what your rate is going to be in 3 years. That's
Gotcha.
the big difference.
So from like a 2-1 buy down, like let's say $20,000 got you down from a 7 to a 5. Like for using a 2-1 buy down, how like that $20,000, how would that work as far as like bringing you down that same 2%? Or like down to a 5? Like would the first year be 1% less and then the second year 0.5% less? Or
I'm going to change this real quick. So give me 2 seconds. I'm going to take out the VA and FHA, and I'm going to show you just conventional. And then I selected buy down type 2-1. Can you see that okay?
yeah.
Sorry, I think I froze my screen. Okay, there we go. All right. So this is a buy down 2-1. And so it shows you the pricing is slightly different, but not a lot. So today it's 7.625, right? And so if you do a buy down, this is actually not showing me what I want it to. Sorry, give me 2 seconds.
Hey.
Okay, so it should be showing this, but it's showing like normal buy down rates. So at this point, if you have a conventional of 7.625, then you'll be at a 6.625 and a 5.625. So that's 2 points. That you're going to buy down. Is that what you're asking, Meziel?
Yeah, I just wanted to know, like, I don't remember what the other numbers were on the other one, but basically is $20,000 going to get you the similar rate if you were to do a regular buy down with like a conventional versus the 2-1 buy down, like what the other two rates in the 2-1 buy down?
Yes. So normally when we're looking at 2-1 buy downs, 2-1 buy downs are normally a little bit more money, which is why I was saying that this looks like the pricing that I was just looking at for a normal buy down. 2-1 buy downs are normally a little bit more expensive.
Gotcha. Okay. To get you basically to the same pricing or as the regular one would give you. Okay.
The difference is that if you refinance out of it, let's say in 6 months, the rates go down and you refinance out of it, that money that you put into that buy down goes back to you to put into the new loan moving forward after you do the refinance. And so if it goes down, right, to 5s from 7.625, you get that money back. And if you're not paying for another buy down, then you can use it for like closing costs.
Thank you.
You're welcome. Sorry, it's a pain in the butt, and the pricing engines are not great when you're trying to use them because they only do so much before you're actually in the loan working with them to lock them. But that's kind of what it looks like when we go in and we look at pricing for your borrowers. Those are all the different little boxes and things that we're looking at for them. Can I answer any other questions for you guys today? No? All right. Well, I hope everybody had a wonderful 4th of July. Thank you all for being here today because I really, really appreciate it. It's good to see all your faces, even if I'm only looking at your picture. that's saved. Just a reminder from Avi to please log your attendance down in the chat box. She would really appreciate that. And I'm sure that's what Amy was going to say, but I stole it. Sorry.
You can steal my thunder all you want. Thanks, Jess, for joining us today and being on after the holiday. And I appreciate everyone who jumped on after the holiday, and do make sure you log your attendance. And today's what, Wednesday? So tomorrow we have forms training at 9 a.m. I don't know.
Don't miss it, because I promise you nobody does forms better than Amy. I've seen her do enough of those classes.
What forms are we going over tomorrow, Miss Amy?
I don't know, but let me check. Hold on. Because Abby is fabulous and she puts it on my calendar. So
Where would you be without Abby?
I would not. You guys would not have me. I would be done. Oh, I think it's just open forum tomorrow. So tomorrow is open forum, which means that if you have questions on any of the forms, you want to go over some of the changes that happened, in June, you want me to recover some of those, or you're having problems with making sure you're filling out something appropriately, like it's just open forum. So bring whatever. It's like quiz Amy on how well she knows the forms tomorrow.
Nice.
Oh, I dare you to try and stump her. I literally, if somebody can stump her on forums tomorrow, I will buy you lunch when I get back in town.
Thanks, Jessica. And this will be the last training that Jessica ever does for us. No.
Hey, that is just shows my faith in you as a forms instructor, because I don't think I've ever had anybody stump you on a form before.
Oh.
Happy Wednesday. Thank you again, Amy, for having me. I appreciate it.
Thank
Okay,
you.
Jessica.
Everybody have a fabulous day.